All right, let's just jump right in. For the past few years, there's been one trade, and pretty much only one trade, that's ruled the market. And it's very likely the one that's powered your entire portfolio. I'm talking about a group of stocks so powerful they literally got their own superhero nickname. But here's the big question. What if the biggest story of yesterday is about to become the biggest risk of tomorrow?
I bet you're nodding your head right now. And you're not alone. I mean, the performance of these mega-cap tech companies has been absolutely breathtaking. They've been the engine of the entire market's growth, right? The names everyone knows, the stocks that just seem like they could do no wrong. But here's the thing about engines. They can't run at full throttle forever.
I know. That sounds like a crazy thing to say. But the data is really starting to suggest that a major shift is coming. The very thing that created so much wealth, that intense concentration, is now creating enormous risk. And you know what? The big institutional players, the whales, they're already quietly repositioning. So in this explainer, we're going to break down exactly why they believe the leaders of 2024 could be dead weight by 2026, and more importantly, where they're putting their money instead.
Okay, first things first. We need to pop the hood on this incredible rally and really understand the illusion that might be propping it all up. Look, this isn't about knocking these companies. They're phenomenal. This is about understanding the brutal, cold, hard market dynamics that are at play.
Now look at this. This chart shows a massive disconnect. These handful of companies make up almost 30% of the S&P 500's total value, its market cap. That's huge. But, and this is the crucial part, they only generate about 20% of the index's actual earnings. That gap you see right there, that is pure uncut expectation. It means investors are paying a gigantic premium for future growth that is, let's be honest, far from guaranteed.
And let's zoom out even further for a second. The top 10 companies in the S&P 500 now account for a full 1/3 of the entire index's value. You have to go all the way back to the 1970s to find a time when the market was this top-heavy. And guess what happened after those other periods of extreme concentration? The market broadened out. New leaders popped up from totally unexpected places. History tells us that what we're seeing right now isn't some new normal. It's very likely the top of a cycle.
And this, well, it brings up a really uncomfortable memory, doesn't it? The dot-com bubble. Back then, a tiny group of tech stocks also seemed absolutely invincible, with valuations that just defied gravity. And we all know how that story ended. It wasn't that the internet was a bad idea. Of course not. It changed the world. But many of those high-flying companies just couldn't live up to the insane hype, and the investors who didn't diversify, they paid a very, very heavy price.
So, why 2026? Why are we pointing to that specific year for this potential shift? It's not about picking a date out of a hat. It's all about a fundamental change that institutional analysts see coming down the pike in the AI investment cycle. Right now, we are smack in the middle of Phase 1, this massive, no-holds-barred spending spree on AI infrastructure. Companies are just pouring billions upon billions into data centers and chips. But the forecast shows that by 2026, the entire story is going to pivot. The question won't be, how much are you spending anymore? It's going to be, what are you actually getting for all that money? We could be heading straight for what the Gartner hype cycle calls the trough of disillusionment, where the focus snaps from hype to the cold, hard reality of return on investment.
And wow, this slide really lays the problem bare. The world's biggest companies are spending over $400 billion a year on AI tools. But so far, all that spending is only generating about $100 billion in new revenue for the companies actually using the AI. That's a $300 billion gap between what's going in and what's coming out. And a gap that huge, well, it's just not sustainable. Sooner or later, the spending has to actually pay for itself with real profits.
And don't kid yourself, the big institutional players, the smart money, they see this coming a mile away. We're already seeing a quiet rotation out of the high-flying tech names and into the more foundational, defensive parts of the economy. You know, the companies that actually build stuff, produce energy, and provide essential healthcare services. They are gearing up for a market where pure, speculative growth isn't the only game in town anymore.
Okay, so if the big leaders are at risk, where do you even start to look? Well, the first part of the answer comes from a classic analogy from the gold rush. You don't bet on a single miner striking it rich, you sell the picks and shovels to all of them.
This is such an important point to get. We tend to think of AI as this magical thing that just exists in the cloud, right? Pure software. But it's not. The AI revolution is being built on a gigantic physical foundation. It needs unbelievable amounts of electricity, crazy complex cooling systems, endless fiber optic networks, and these massive, sprawling data centers.
It's a business of physical atoms, not just digital bits.
So here's the pivot. Instead of focusing only on what we can call narrow tech, the companies making the AI models and the software, the big opportunity is broadening out to the companies that enable the entire system. We're talking about the power grids, the thermal management, the networking gear, the industrial construction. These are the picks and shovels of the 21st century.
And these aren't just vague ideas. These are real, tangible companies. You've got firms like Vardev and Modine that are experts in the critical cooling tech that data centers can't live without. Networking giants like Arista and Marvell that build the super-fast connections for everything. Industrial companies like EMCO that physically build and install these incredibly complex facilities. And that's not even mentioning the utilities that have to provide all the power. These are the companies that win no matter which AI model ends up on top.
All right, the second part of this strategy is about completely changing your hunting ground. It's about finding those hidden gems that the giant institutional funds are basically forced to ignore, and that gives you, the individual investor, a really unique edge.
It's a simple idea, but it's so powerful. Think about it. A massive fund like Berkshire Hathaway has to deploy billions of dollars at a time just to move the needle on its portfolio. They literally cannot buy shares in a small $500 million company. It wouldn't even show up as a rounding error. But you can. And this opens up an entire universe of smaller companies, the so-called puppies, where you have a genuine structural advantage over the giants of Wall Street.
So what do these undiscovered companies even look like? Well, the legendary investor Peter Lynch had this amazing checklist. And it's kind of funny. He said to look for companies that might have a slightly silly name or do something mind-numbingly boring, or maybe they operate in an industry people just prefer not to think about. And because of all that, they get completely ignored. EMCR, for example, doesn't build flashy AI. It does electrical and mechanical construction. It's dull, but it's essential. Or Modine Manufacturing. They make thermal management systems, basically fancy radiators. Not exciting, is it? But it's absolutely critical for cooling data centers. These are the types of overlooked businesses that don't make headlines, but are totally essential to the real economy. And they're often completely mispriced because the herd just isn't chasing them.
Okay, so we've covered the why and the where. Now let's get down to the how. Let's pull all these threads together into a new playbook for finding real value in this changing market.
A crucial tool in this playbook is focusing on free cash flow. Just forget about reported earnings for a minute. Those can be massaged by accounting rules. Free cash flow is the actual, cold, hard cash a company has left over. The FCF yield tells you exactly how much cash the business is kicking out relative to its stock price. It's just a much more honest way to measure a company's health. And in a world with inflation, you want to find companies that also have pricing power, the ability to raise prices without losing customers. A business with high FCF and strong pricing power, that's a fortress.
And this right here, this brings us to the brutal truth of that valuation gap we talked about. The price-to-book ratio basically measures what you're paying for a company compared to its actual net assets. For NVIDIA, a superstar of narrowtech, investors are paying 47 times its book value. 47. Now look at Intel, a classic picks and shovels company. Investors are paying just over 1 times its book value. That staggering difference is the opportunity. It's the market pricing one company for absolute perfection while totally ignoring the productive, cash-gushing assets of the other.
I love this quote from the legendary Howard Marks because it just perfectly captures the whole point of this shift. Successful long-term investing isn't about chasing the hottest trend at any price. It's about managing your risk, understanding what something is actually worth, and avoiding those kinds of over-concentrated bets that can just wipe you out. It's about playing the long game.
So really, it all boils down to this single question. The strategy that worked brilliantly for the last 10 years might not be, and probably won't be, the one that works for the next 10. The market is always moving, it's always shifting, and right now, the leadership is broadening out. So the question you have to ask yourself is this: is your portfolio set up for where the market has been or for where it's going?